annual growth rate of non-farm employment was revised down significantly. The U.S. employment revision acted as a bearish factor for the market, but this was offset by expectations of an interest rate cut in September. The majority of Federal Open Market Committee (FOMC) members supported a September interest rate cut at the July meeting. Regarding the outlook for U.S. inflation, the attending committee members judged that recent price indicators have increased confidence that inflation is moving stably toward the 2% target. Regarding the labor market, many committee members noted that recent employment indicators may be exaggerated. The non-agricultural employment report is the most important indicator that the U.S. Federal Reserve FOMC refers to along with the PCE CPI price index when deciding monetary policy, such as freezing interest rate cuts or raising interest rates. If the employment report shows that employment has slowed, the Federal Reserve's FOMC will have room to lower the benchmark interest rate. According to the FOMC minutes released by the Federal Reserve on August 21st, local time, many members at the meeting strongly supported policy easing in September, and some said they were willing to cut interest rates immediately in July. A majority of committee members said it would be appropriate to ease the policy at the next meeting if data continues to come in as expected. The Federal Reserve maintained the interest rate at 5.25 to 5.50% at the last meeting, but according to the minutes, several members at the time argued that there was a valid basis for lowering the interest rate by 25 basis points, saying that inflation was making progress amidst rising unemployment. On the other hand, some committee members expressed concern that premature easing of monetary policy could lead to a resumption of inflation. Several participants also noted that easing restrictions too late or too little could unintentionally weaken economic activity or employment. In particular, several committee members said, recent progress on inflation and rising unemployment provide an appropriate context to cut the benchmark interest rate by 25 basis points or support such a decision at this meeting. FOMC members have not discussed interest rate cuts in such detail since entering the interest rate hike cycle. The market welcomed the Federal Reserve's Fed willingness to ease monetary policy. The U.S. Department of Labor announced the benchmark revision, preliminary, for current employment statistics on August 21st, local time. Every year, the Ministry of Labor revises the benchmark for the monthly employment report to reflect the quarterly employment and wage survey. Preliminary values for indicators for the 12 months up to March of the year are announced in August, and final values are released in February of the following year. Announced on this day were preliminary figures that revised the number of new employees in the non-agricultural sector for the 12 months ending in March of this year. The intention is to more accurately count the number of people newly hired from April of last year to March of this year. This figure was adjusted downward by 818,000, a significant decrease from the previous figure of 2.9 million. The decline is approximately 30% of the previous figure and is the largest since 2009. The Non-Farm Employment Index, non-farm payrolls, measures the change in the number of employed people from the previous month, excluding the agricultural and livestock industries. Job creation is the most important indicator of consumer spending, which accounts for most economic activity. If the actual figure is higher than expected, it means that the value and outlook for the US dollars are positive. If it is low, it means negative, as the market's core interest has recently shifted to US employment and unemployment. The market can fluctuate rapidly depending on the extent of the correction.